Ever wondered why the market moves the way it does? It all comes down to liquidity. Stick around as we uncover the secrets of spotting and using liquidity in your trades to stay ahead of the game. Now you are probably wondering, what is liquidity? Liquidity refers to where traders place their stop orders, and these stops are usually found at obvious price levels on the chart, such as highs and lows. Liquidity refers to areas in the marketplace where there are a lot of orders waiting to be executed. This typically occurs around the most obvious highs and lows on the chart. And why is this? It's because there are a lot of different strategies that tell people what to do above a high and below a low. And what else is above a high and below a low? We find our buy stops where people are trying to continue buying above a high, right? And we find sell stops below a low because people are trying to continue selling below that low, right? So we have to understand that these spots, or the most obvious, are recent highs and lows. Traders who shorted at a high will place their stops above that high, which is buy side liquidity. Now buy side again is where traders have placed their stop loss orders above the marketplace, expecting price to drop. But now if we want to look at what else is there, there are buy stops there. Why? Because people are willing to actually continue buying if the price breaks above those highs, right? And on the flip side here, looking at our sell side, traders who went long will place their stops below recent lows, creating sell side liquidity. And sell side liquidity is where traders have placed their stop loss orders below the marketplace, expecting the price to rise. Now if we look at these lows, what else might be there? There might be sell stops. Why? Because people are willing to continue selling down with the market as soon as it breaks that. But we wouldn't be looking at continuing selling after the market breaks below a low, or continuing buying after the market breaks the high. So identifying these points help us understand where significant price move might occur in the marketplace, right? And there are deeper liquidity zones, obviously, and not just your recent highs and lows or the obvious highs and lows, but there are some other very, very specific and obvious points. And in that, we can also look for liquidity in less noticeable areas. For example, around previous session highs and previous session lows, previous weeks high and lows, previous days high and lows, previous month high and lows, and previous quarters high and lows, right? And also certain candles on the chart can also show areas of liquidity. The buy side is above the market highs, and the sell side liquidity is below the market lows. Anyone who went short would have their stop above, creating buy side liquidity. Similarly, anyone who went long would have their stops below a low, creating sell side liquidity. So what does this mean? It means when you see the market making some sort of move below a session low, right, you want to look at you trying to buy that zone, or finding a price where you are willing to buy something at a cheaper price. Because think about this again, right? When price goes below some certain low, it proves now that price is getting cheaper and cheaper. When price goes above a previous high, that tells you that price is getting expensive, right? And I hope you understand everything that we are talking about here. right? Because it's very crucial when you are trying to find your trading setups. So once liquidity is identified and taken out, so let's say we're looking at previous days high in this example, right? Once that liquidity is identified and taken, it signals a good time to look for a trade set up. So you don't want to just immediately sell after price took out a high. You want to look for a signal it's gonna give you, right? That signal will be a signal for you to actually start looking for your trade setup or trade entry. For example, here, when the buy side liquidity is taken out, it can create an opportunity to go short. And like you see here, we actually have our fair value gap. There is an order block as well right here. The candle that broke above that previous daily high was an order block. I just didn't want to mess up the whole presentation when I was making this, but there is an order block right there. So traders typically place their stop near significant highs and low within a range, and this makes these levels crucial for identifying liquidity. So when a previous day high, previous session high, month high, previous week high is taken, right, we want to look for signals for us to sell there, right? And it's not going to be a signal from an indicator, unfortunately, but it's you using, it's either an order block, fair value gap, a breaker block, your inverted fair value gap, and all those kind of things. And if you do not know any of those things, I advise you watch a video that is gonna be pinned on the top right corner just now, and it's gonna explain more about that. Or you can simply watch any of my other videos explaining about you mastering price action, or you learning more about order blocks and fair value gaps. Most of the time, you only want to get a trade after the market takes out an important high or an important low. And we've already said all the kind of lows that you can actually aim for. If you have any question regarding this, you can leave it in the comments. Please make sure that you subscribe to the channel and like the video and comment what you learned and what you would like to learn next. Up until next time, good luck and good trading.